Good morning and good afternoon to our audience joining us from London and from China. My name is Fei Ye. I'm the head of China and India at the City of London Corporation. And I'm delighted to be joined today by our excellent panel of speakers to discuss cross-border use of RMB bonds as collateral. China now is the second largest bond market in the world. And with the opening up of China's financial market, and also the inclusion of Chinese securities into global indices, demand for Chinese securities from international investors was significantly boosted. So with investors around the world having increased the Chinese securities in their portfolios, they are looking for ways to maximize their utility, including looking at how they might accept the securities as collateral. So in March this year, CCDC and ISDA jointly issued a new white paper, Use of RMB-denominated Chinese government bonds as margin for derivatives transactions, to explore how this can be done. So in today's workshop, we will hear from both CCDC and ISDA about the findings and recommendations from their research. We have also invited a number of leading industrial experts and who will give their views and from their perspective as market participants. And this is also the first workshop led by the newly established London RMB Financial Market Infrastructure Sub-Working Group under the London RMB Business Monitoring Group, co-chaired by the City of London Corporation and the People's Bank of China Representative Office for Europe. And the London RMB Financial Market Infrastructure Sub-Working Group was established in January this year with members including most of the major onshore and offshore financial market infrastructure providers in the UK and China. And the main work objectives for the sub-working group was to, the main work objectives of the sub-working group are to support the main working group to address technical issues concerning market access, market connectivity, and products expansion. So before we start the workshop, I will start with just a little bit housekeeping. And so please be aware that this event is being recorded and will be shared on various digital platforms in the coming days. And please post any questions you have in the Q&A box at the bottom of your screen, and we will try to take some of them later on in the session. So without further ado, I would like to first invite Madam Jing Mei, the Chief Representative of the People's Bank of China Representative Office for Europe and co-chair of the London RMB Business Monitoring Group, to share her welcome remark. Madam Jing Mei, please.
Thank you, Fei. Dear Mr. Xu, dear Mr. O'Malley, members of the London RMB Business Monitoring Group, ladies and gentlemen, good morning in China and good afternoon. Good morning in UK and good afternoon in China. Thank you very much for participating in today's workshop, Cross-Border Use of RMB Bond Collateral, which is hosted by London RMB Business Monitoring Group. On behalf of the Monitoring Group Secretariat, I would like to extend a warm welcome to all our distinguished guests. In recent years, China has been working hard on its reform and opening up. Overseas institutions have participated in China's financial market through various channels and built up their holdings of onshore financial assets. As of April 2021, onshore RMB bond holdings by overseas institutions exceeded 3.6 trillion yuan. Notably, overseas investors were holding over 10% of outstanding Chinese government bonds, thus becoming an important driving force for market development. London RMB Business Monitoring Group was launched in 2018 with representatives from key financial institutions in the UK and co-chaired by the People's Bank of China Representative Office for Europe and City of London to further facilitate regular dialogues between financial market infrastructure providers and investors. We set up the Financial Market Infrastructure Sub-Working Group under London RMB Business Monitoring Group in December 2020. Today's workshop is the first event since the establishment of the Financial Market Infrastructure Sub-Working Group, and the topic was chosen based on the recent release of a joint white paper, which was published by CCDC and ISDA. The white paper discussed the potential use of RMB bonds in the international derivative market, echoing with the urgent demand for high-quality collateral in the global market. Similar to inclusion of RMB in the SDR basket and the inclusion of RMB bonds in major indices, the cross-border application of RMB bond collateral is also believed to be a market-driven natural process. Hopefully, today's workshop could provide global investors with a new perspective on the Chinese bond market. Finally, I wish this event a best success, and I would like to ask for your continued attention on the opening up of China's financial market, as well as updates from London RMB Business Monitoring Group, including Financial Market Infrastructure Sub-Working Group. Thank you for your attention.
尊敬的精美女士，尊敬的 Scott 先生，各位领导、女士们、先生们，大家好，欢迎参加此次由中国人民银行欧洲代表处、伦敦金融城和中央结算公司联合主办的线上论坛。首先，我谨代表中央结算公司向参加本次会议的领导、嘉宾表示热烈的欢迎。近年来，中国债券市场持续保持快速发展势头，成为中国乃至全球市场的一大亮点。人民币加入 ISDA， 中国债券陆续纳入国际主要债券指数等系列事件，表明国际市场对于人民币资产的认可度逐步提高。当前，中美利差依然维持在150个 BP 以上，境外机构对人民币债券的投资量持续攀升，已连续29个月增持，今年4月就增值超过600亿元。截至4月末，境外投资者持有境内人民币债券的总量达到 3.62 万亿元，其中 3.22 万亿元近 90% 都托管在中央结算公司。随着债券市场对外开放力度不断扩大，境外投资者取得中国债市的入场券已经越来越便利。在将境外客户引进来的同时，如何能够更好的留下来，这需要金融居所设施发挥专业优势，向境外客户提供更好的综合性服务。在主管部门和市场机构的大力支持下，中央结算公司持续优化入市后服务支持，推动更多满足市场需求的金融产品创新。其中，在担保品业务领域，公司作为全球最大的担保品管理平台之一，一直致力于推动人民币债券资产的跨境应用，已取得了多项创新突破。目前，公司已经支持多家境内外金融机构开展跨境融资、离岸发行、 货币互换等跨境业务。2019年6月，公司推动人民币债券成为英国市场普遍接纳的合格担保品，纳入了第10次中英财经对话成果，从国家层面予以关注和支持，为人民币债券担保品跨境应用提供了新的切入点。在此背景下面，公司与国际调级与衍生品协会开展合作，联合发布白皮书，使用人民币债券冲抵场外衍生品交易保证金，全面探讨了人民币债券在国际衍生品市场的应用。作为中国金融基础设施与国际权威行业协会首次合作的白皮书，我们期待以理论探讨推动业务实践，为全球投资者拓宽人民币债券的应用路径。为此，我们也正在与全球托管行等境外机构开展紧密合作，着力从基础设施层面加强互联互通，进一步丰富跨境服务场景。跨境担保品的合作与创新是一项具有重要意义的工作，需要基础设施行业协会和市场机构等金融业态的共同努力。今天我们有幸邀请到多位金融市场权威专家，围绕人民币债券跨境应用这一主题分享新发展和新动态。我也热切期待在线的各位专家可以通过本次活动碰撞更多的思想火花，凝聚更多观点共识，收获更多关于中国债券市场扩大开放的真知灼见。最后，祝本次线上会议圆满成功，谢谢。
Madam Jingmei, and thank you, Mr. Xu. And now I would like to invite Mr. Scott O'Malley, CEO of ISDA, to kick off the presentation by ISDA and CCDC on their joint report. And it will then be followed by a presentation by Ms. Li Yuan, who is the lead manager of Customer Service Department, China Bond Collateral Management Center at CCDC, and also from Graham Bryant, and who is the counsel at ISDA London office. Scott, please.
Thank you. Good morning. Thank you very much to the City of London Corporation and the CCDC for organizing this important event and inviting me to deliver the welcoming remarks. It's a privilege to address the London RMB Business Monitoring Group and to speak alongside Madam Jingmei from the PBOC and Mr. Xu Langdui from CCDC. I'm delighted to be able to share some reflections at this very exciting juncture in the evolution of China's capital markets. The global margin requirement for non-cleared derivatives has been a major focus for ISDA over the past 5 years. This is one of the major financial reforms that was put in place after the financial crisis to make sure the system was safer and more resilient. ISDA has worked with its members and regulators to implement the margin requirements since the first phase began in 2016. We now have just 3 months to go until the deadline for Phase 5 entities to begin posting margin on September 1, and this will be followed by Phase 6 in September of 2022. We expect a large number of firms in Asia Pacific, including many smaller entities, to come into scope during the course of these final 2 phases. By this point, firms should be well advanced in their preparations and will already be thinking about the collateral they may intend to post. Given the rapid growth and liberalization of China's bond market in recent years, many firms are keen to explore the use of Chinese government bonds as initial margin. They need to properly understand the associated legal, regulatory, and market structure issues before making this decision. That's why the paper we published in collaboration with the CCDC is so important and timely. Now available in English as well as Chinese, the paper provides a detailed analysis of the challenges that arise from the use of Chinese government bonds as collateral and sets out our medium and long-term recommendations. These include improving the collateral enforcement regime and enhancing the role of financial market infrastructures. I'm looking forward to hearing more about these issues and more during today's conversation. Now, this event comes at an exciting time for Chinese financial markets. On April 29th, the Standing Committee of the National People's Congress of China published a draft futures law for consultation. Among its provisions, the draft bill appears to explicitly recognize netting enforceability in the over-the-counter derivatives. This is a seminal development for which we at ISDA have been consistently advocating for a number of years. In my remarks today, I will explore the recent developments in the liberalization of the Chinese markets, the role a robust derivatives market can play, and why recent progress on netting is so encouraging. The growth of the Chinese financial market has been one of the most defining trends of recent years. As we have lived through the financial crisis, a wide-ranging regulatory reform program, and most recently a global pandemic, China's economic growth and the liberalization of its markets have created new opportunities for financial market participants around the world. China's bond market is now second only to the US, while RMB is the 8th most traded global currency. As the world emerges gradually from the grip of the pandemic, China is clearly poised to resume its growth trajectory. The IMF has projected real GDP growth that will bounce from 2.3% to 8.4% later this year. Important steps have also been taken over the past year to maintain the momentum of liberalization efforts and to lower the barriers to international participation. In November, the PBOC, CSRC, and SAFE combined the flagship QFII and RQFII investor schemes and removed constraints on the size of positions international investors can take in the Chinese markets. These new rules simplify and streamline the licensing process, allowing investors all over the world to actively participate in the growth of China's economy. Overseas investors can now choose to use an ISDA master agreement for onshore RMB derivative transactions, following a joint circular issued in February of 2020 by the PBOC. Other agencies and other agencies on accelerating the terms of Shanghai as an international financial center. This means that derivative market participants can now enter into RMB transactions with the contractual certainty provided by ISDA documentation. It also improves operational efficiencies as internationally active firms can use the same documents for all transactions without having to switch to a different document when trading with Chinese entities. FX hedging rules have also been relaxed so that foreign investors can manage their currency risk while transacting in the bond market. While the PBOC and CSRC have taken joint steps to bring together the interbank bond market and the exchange-traded market as well. Collectively, these measures constitute strong progress on the ongoing liberalization of China's capital markets. This will boost international participation, which will lead to deeper liquidity. Now, I have cause to reflect on many of the benefits of safe and efficient derivative markets, and this is particularly relevant in the context of China. As Chinese markets continue to open up and attract participants from all over the world, it is important now more than ever that robust tools are available to enable institutions to effectively manage their risk. The derivatives market adds fundamental value by allowing companies and individuals to transfer risk appropriately, which creates a certainty that's needed for economies to prosper. By allowing companies to hedge their risks, the risks they face, derivatives can provide certainty and stability, thereby supporting economic growth. A well-functioning derivative market also allows banks to manage their risk as well. In turn, this means they can increase lending to the real economy, supporting liquid and capital markets. In short, derivatives are a vital component to the global financial system, allowing risk to be managed and promoting liquidity and transparency in markets. As the derivative markets have become more complex and interconnected, it has become more important than ever to have a robust and predictable legal framework in place. This must include enforceable rules on closeout netting and related collateral arrangements. By allowing parties to combine their obligations into a single payment, closeout netting mitigates the credit risk associated with transactions and promotes financial stability. It also encourages more active participation by both foreign and domestic participants, supporting liquid and efficient capital markets. ISDA has worked with authorities all around the world to advance progress on netting enforceability. ISDA's Model Netting Act has provided a template for legislation that can be applied to markets where netting is not yet recognized. So far, we have netting opinions in over 70 countries. Major progress in China, with a number of significant developments in the recent years leading up to the publication of the draft futures law on April 29th, is a very important development. The draft bill expressly recognizes the enforceability of netting in OTC derivative transactions during bankruptcy proceedings. Market participants have noted the enormous significance of this legislation as a possible turning point in the development of the Chinese derivative markets. In addition to the risk mitigation benefits, closeout netting is recognized as risk reducing when it comes to setting regulatory capital market requirements as well. Firms can also exchange collateral on a net basis under the margin requirements for non-cleared derivatives. This will reduce costs and will create more favorable conditions for international participation. Last week, ISDA and ASIFMA submitted a joint response to the public consultation on the legislation, in which we welcomed the progress on netting and recommended additional provisions regarding the enforceability of collateral arrangements in OTC transactions. Given the growth of China's bond market, the imminent deadlines for non-cleared margin rules, and the recent progress on netting, this is an opportune time to discuss the important use of RMB bonds as collateral. Recent developments give me an extraordinarily high level of confidence that China's financial markets are headed in the right direction for further growth, deeper liquidity, and greater legal certainty. We look forward to working with market participants and policymakers to ensure that to address the challenges and tap the opportunities that lie ahead. Thank you very much.
Sorry for the slight hiccup there. So yeah, I'd like to start by reiterating what Scott mentioned and my gratitude to the City of London Corporation and CCDC for both organising the event and for inviting me to speak. So I wanted to just briefly touch on the white paper that we issued jointly with CCDC. So I won't go into too much about the kind of rationale and the drivers behind the paper, because I think, you know, liberalisation of Chinese bond markets and those excellent developments over recent years, alongside the regulatory IM backdrop, has been covered in excellent detail already by our previous speakers. I will also say that although I am a lawyer and there are certain legal elements to the ISDA section of the paper, really the majority of the legal analysis is in the parts that CCDC covered, being sort of local law issues. So I will leave those issues and other issues of collateral management to my peers from CCDC and really sort of describe at a high level the kind of operational and practical issues that our section of the paper in particular looked into. I will also flag that we were supported significantly by margin reform on the production of this section of the paper, who I know are on a panel later on and will be able to speak far more eloquently to these issues in detail and substantively than I will. So I'll just provide really an overview. So I think, as I mentioned, the background, you know, the background section of the paper, so looking at the slide on your screen, the background section of the paper really covers the driving factors behind the paper, so developments in the China bond market and the kind of regulatory backdrop to initial margin, which, as I mentioned, has already been covered in some detail. Then we look at some of the market access issues. So there's a section on the kind of the developments, the kind of improvements to market access in China, shall we say, and some of the remaining challenges. And then the real key part of the paper looks at the operational challenges, which, as I mentioned, margin reform will likely speak to in more detail, but a lot of those I think can relate to things like integrating Chinese bonds into firms' trading systems in order that they can efficiently manage that asset through their operational processes, and also you know, issues of market standardization. So, for example, things which may seem relatively basic, but even down to things like terminology, where you have mismatches in terminology that can create issues in the operational chains. We also look at the custodian setup, as you'll all likely know, that regulatory IM requires a segregated custodial setup, which in actual fact is a challenge for IM generally. So obviously that challenge is somewhat exacerbated where you're talking about a kind of a newer or more developing asset. We then also look a little bit into the regulatory environment and issue of optimization. I think this really goes to the point that initial margin and collateral generally, for that matter, is no longer what it might have previously been described as a bit of an afterthought, whereas now I think it's a pre-trade sort of commercial factor that really goes to all aspects of the trading portfolio and is required to be monitored on an ongoing basis for efficiency and effectiveness. And then we look a little bit to the future, so what's going to happen and how we think that best will take place. So yeah, that was all I was going to cover. That's sort of brief overview of our section of the paper. So I'll hand over now to my friends at CCDC to cover their sections. Thank you.
Okay, thanks. Hello, ladies and gentlemen. I'm Charlie from Collateral Management Center. It's my great honor here to sharing cross-border practice of CCDC collateral management with you. And as one of the authors of the white paper, CCDC mainly explores the feasibility of use of CGB as collateral in derivatives transaction, its challenges and expectations. As you know, use of RMB-denominated CGB as margin for derivatives transaction is only one aspect of the cross-border use of RMB bonds collateral. So today my introduction contains 3 parts. First of all, I'll briefly introduce current collateral management system of CCDC and why we are caring about the application under cross-border scenarios. And next, I'll share existing use of RMB bonds in cross-border business. Finally, let's take a look at several innovative trials of collateral management machine designed by CCDC. First of all, let's take a look at current collateral management system. As mentioned in the white paper, CCDC's collateral management services was launched in 2011, and we can see in this chart, the amount of collateral management has grown at a large range from 3 trillion yuan in 2013 to nearly 16 trillion yuan in 2020. We currently provide professional three-party service for over 9,000 market participants, becoming the largest bond collateral management institution across the globe. Our collateral management service covers various fields across China's financial market, including the monetary policies of the central bank, financial policies of MOF, foreign exchange management policy, social security system, derivatives market, international financial and economic cooperation, and cross-border collateral business. While CCDC's collateral management service continue to develop, we have also noticed that driven by the fundamentals of the Chinese economy and opening up of the bond market, the number of foreign investors entering China's bond market is increasing, which was mentioned by Mr. Xu. So, how to help domestic and foreign investors to use RMB bond as collateral and improve the efficiency of cross-border business has gradually come to our great concern. Here, I will show you some cases which may be mentioned in the white paper. The first case is using bonds as margin for future contract in China's market. As we introduced in white paper, in domestic market, CCDC devotes to diversify application scenarios for bond collateral. Began in 2015, we cooperate with CFFEX to use treasury bonds as margin for CGB future contracts. And in November 2019, the scope of this business has expanded to all the future products of CFFEX. And for the first time, supported overseas customers to participate in the future merging business with bonds. At the same time, we jointly signed an MOU with 4 domestic future exchanges, expanding this machine across domestic derivatives market from financial future region to commodity futures. Last year, bonds has future merging business was officially launched in Dalian, Zhengzhou, and Shanghai Commodity Future Exchange respectively, ushering the new stage in the interconnection of the spot future market and the innovation and cooperation in the derivatives market. At the end of 2020, we have more than 100 counterparties with current business scale about 30 billion yuan. So far, CCDC has been actively promoting the cross-border use of RMB bond collateral in different scenarios, like in cross-border issues, cross-border swaps. The second example is using RMB bond collateral in Shanghai Free Trade Zone financing project. In April last year, we cooperated with commercial bank and the financial leasing company to land the first foreign currency financing collateral management business in the Shanghai Free Trade Zone. In this business, domestic commercial bank provides USD loans to financial leasing companies' overseas subsidiaries, and the bank settlement agent of this overseas institution acts as a guarantor, which provides RMB treasury bonds as collateral held by this overseas one. CCDC performed the duty of a collateral manager, performs promoting work such as valuation, mark-to-market, and collateral evaluation on the secured assets pool, as well as enforcement rule, and provides the participating parties with comprehensive and detailed data information on the collateral assets pool. The last case I want to share is our enforcement rules. As we know, in the international market, solutions for disposition of collateral are relatively mature. Under title transfer mode, the collateral assets can be directly disposed to the collateral receiver. But in China, we use pledge mode. So in the event of default, efficient disposition of the collateral has become one of the greatest concerns to foreign investors. This problem was already being solved with CCDC's collateral enforcement rules published in 2019. The rules allowed the observed party to entrust CCDC with quick collateral disposition through auction, private sale, or conversion to value, which takes only 1 to 3 working days. Of course, it is undeniable that the Chinese market has its own characteristics in terms of legal basis, regulatory framework, and trading habits. So we have to face challenges from various aspects in the process of promoting the cross-border use of RMB bonds. These are also mentioned in the white paper, and these problems cannot be solved immediately. But we have always been committed to exploring and innovating good solutions with all parties. At the strategic level, we put forward the proposition of multi-tiered service, win-win collaboration. A couple of words stands for the basis of our service. It means CCDC is actively exploring cooperation with institutions to provide global clients with improved and more convenient cross-border collateral management service without challenging the legal and market practice of either side, while sharing benefits with each other. At the innovation level, we actively promoting third-party collateral management service and provide a broader space for the cross-border use of RMB bond through a professional, intelligent, and standardized collateral management model. At cooperation level, in addition to the exploration of using RMB CGB as merging for derivatives transaction with ISDA, we also actively organize various activities, such as the annual Collateral International Meeting, hoping to provide the professional and open platform for investors from all over the world. In there, they could be discussing the most concerned topics in the industry and exploring opportunities and collateral management cooperation together. That's all of my speech today. We hope to work with all of you to explore better ways to promote the use of RMB bonds collateral under different cross-border scenarios. Thanks again for listening.
Thank you, Liyuan, and thank you, Graham. Next, I would like to hand over to Mr. Luke Brereton, and he is the Global Head of Sales and Financing and Security Service at Standard Chartered Bank, to share more about how to use RMB bonds as collateral in our current financial markets. Luke, please.
Hi, thank you very much. I'd just like to thank the CCDC and the City of London Corporation for organising this workshop, this seminar, and for also inviting me to come along and tell you a little bit about what we've been doing at Standard Chartered Bank. So thank you very much for the invitation. We can just flick to the next slide. What I'd like to talk to you about is a problem that was presented to us about 5 years ago, I think. So one of the roles that I've been doing at Standard Chartered Bank was to build out a prime services business. And part of that was FX prime brokerage. This is essentially where clients can trade FX, spot forwards, NDFs, options, etc., with a multitude of different dealers. And when they do those trades, they give those trades up to Standard Chartered Bank. So the dealers are facing Standard Chartered Bank. That's their counterparty credit risk. And then we mirror that trade back to the client. So we have counterparty credit risk to our client. This is a very popular service amongst hedge funds, for example. And we had a set of hedge fund clients located in Hong Kong. And when we provide the service to them, we settle variation margin every day in cash. So we take the mark to market of the portfolio and we settle that every day in cash. And we also hold back a reserve, some initial margin, to cover the potential closeout costs of that portfolio should the hedge fund client no longer be able to financially perform. In that instance, we become the owner of that portfolio and we have to close it out. And I'd go to my trading team to do that. And there could be some slippage and some costs associated with that. And that initial margin is sort of designed to cover at least a 10-day margin period of risk to close out those positions. And we evaluate the size of that initial margin every single day using our own kind of proprietary models that we explain to our clients. Now, that initial margin needs to be high quality collateral and it needs to be fairly liquid. So in the event that there is some kind of default of a client, we need to be able to go into the market, close out their FX portfolio and use that initial margin to cover the costs of putting those hedges on. At the same time, we had quite a few clients, understandably wanting to invest in onshore Chinese govies. And they wanted to have, those large holdings in Chinese govie bonds. Now, at the time, we only accepted, a subset of collateral as initial margin. I would say clients typically posted cash or US treasuries. That was predominantly what we were receiving as initial margin. But we were keen to extend the eligibility to include Chinese government bonds. And that presented to us a few challenges that we needed to overcome. Now, the benefit to the client is that, they were attracted to having a lot of their assets under management invested in Chinese government bonds in order to pick up the yield as part of their investment strategy and the diversification of their portfolio. The issue was that there was no offshore financing of those bonds, so they were fully invested and they couldn't really leverage that holding in any way. So we came up with a way in which we could extend the eligibility criteria for initial margin to include Chinese government bonds. And this way, they could take those holdings and they could pledge them to us, to the bank, to Standard Chartered Bank, to the business that I was running, in such a way that we can use them in the event that there's a default with the client. We can use those Chinese govies to cover the cost of closing out their portfolio. So that was a nice solution to help them to continue to hold those bonds in the way that they did. So if we just flick to the next slide, I'll take you through how we solved this. Thank you. So what we did is we have an ISDA relationship with the client, who's probably a Cayman fund managed out of Hong Kong in this example. And so it's a normal, UK law, very straightforward. And the FX prime brokerage, so all those FX transactions that I was referring to earlier, they're all governed under that ISDA relationship. So that's fine. That's very straightforward. And then we'd open up the client would open up with us a custody account. And they can go to Standard Chartered Bank in Hong Kong and open up a custody account. And through that one custody account, that international custody account, they can access, multiple markets that Standard Chartered Bank service, including onshore China. And what we're able to do with that account setup is to actually create a segregated account for the client. So the assets inside that account are still in the client's name, but we use a notice to custodian, which is a very short legal document. It basically says that the client basically agrees that they cannot withdraw the assets from that particular control account, that SCB needs to be notified before and agree to any withdrawals of assets from that account. So it kind of locks up the assets in that account. And that's really important, because if they're putting initial margin into that account, I need to know that they can't take it out without my say-so, because I'm relying on that initial margin as part of my risk management framework for the FX prime brokerage business. So it's very straightforward. The client opens up a custody account. We create this little control account for them. We put this notice to custodian in, and the client can then custody assets in that control account. And then finally, Standard Chartered Bank London in this instance, takes a pledge over those assets. And that means that in the event that the client goes into default, those assets belong to Standard Chartered Bank, and we can liquidate them, and we can use those costs to cover the cost of closing out the risk exposure that we had of the client through the FX prime brokerage agreement. That's great. That works really well. And it's something that we've got in place in other markets, but extending it to include Chinese government bonds presented a few challenges. So the coming together of different legal frameworks, for sure. And the pledge structure works excellently. And I thought that was a great presentation that we just had from CCDC Collateral Management Service Center, and hugely encouraging to see how extensive that service has come from. And likewise, with the developments that have happened on closeout netting in China is so welcomed. That's absolutely fantastic. We were solving for these problems about 4 or 5 years ago, so before a lot of this work was done. And we noticed with China, of course, it's an ID market, which means that you can't do transfer free of payment. So normally what we would see is collateral transferring from the control account to our own account, to our own trading account, free of payment. But that's not possible with Chinese govies. So we needed a mechanism by which we could sell those Chinese govies and then divert the proceeds of that sale into our own accounts, which is possible. So we had to add on to this arrangement something a little bit new, which was a tri-party agreement between Standard Chartered Bank, the client, and the trading app that they were going to be using to buying and selling these Chinese govies. And that has to be in place so that in the event that there's a client default, we can actually take over those assets in that pledge account. We can sell them. We can divert the proceeds of that sale to our own account. And therefore, we've got the funds required in order to meet the closeout costs of that FX derivatives portfolio that I mentioned earlier. So we managed to put all of this in place. And then we took our first client live and worked very well. We've been through a few tests. And now this has been up and running for probably about 4 or 5 years. And we've got a number of clients that use us for it. And they like the fact that they can have these holdings and that they can pledge them as part of this, arrangement as using us as an FX prime broker. Now, we like it. because it's giving our clients a service which is pretty unique in the market to use this collateral in this way. And also it meets all the criteria that we need in order to get regulatory capital relief on the risk that we're carrying on the FX prime brokerage business. That's great. So it gives us the reg relief. And it also meets all the criteria to fit into our risk framework that we have in place to, protect our prime services business. And so that's really where we're at the moment. And it's something that we continue to use and offer. But I see, based on a lot of the presentations that we've had already this morning, the market's moving on, and I can see broader adoption of this collateral within the ISDA framework, which is excellent and very much welcomed. And I think I can pause there and open up to any questions.
Great. Thank you very much, Luke. I really enjoyed hearing your explanation on how that actually works in real life. So I have a couple of questions here from the audience. Yep. The first one is to you, Luke. Are there any limitations to use Chinese government bonds as initial margin in this model? Or can we use 100% of the CGB as initial margin?
Yeah, okay, that's a great question. We, as part of our risk management framework, yes, I put a limitation on it. So we have concentration criteria. So we don't want our initial margin to be made up of just one collateral type. We want to have a diverse set of collateral. So we put upper limits on how many bonds we would actually accept from any given distribution or any different issuer. We also look for wrong way risk as well, where we may have currency risk. So if we've got a currency position that is going out of the money and we have collateral that's in the same currency, then we've got a double problem to deal with. So diversification and and caps become very important in that situation as well. So there are a few limitations that we put in place, and that's part of the risk management framework.
Great, thank you very much, Luke. The next questions I think is referred to CCDC Li Yuan and also ISDA Graham. So besides OTC derivatives market, is there any other ways of using RMB bonds, particularly in the international exchange markets?
Well, in the presentation, we have seen that RMB bonds collateral has been used in domestic exchange derivatives market where QFII and RQFII can participate. And meanwhile, we have noticed that there is a strong demand for the potential use of RMB bond collateral in the international exchange derivatives market, especially with the increasing participation of Chinese financial institutions in the global financial market. However, for now, the practice of posting RMB bond collateral in the international exchange derivatives market has not been implemented yet, mainly because each exchange is prudent about the review of new eligible collateral and the assessment, and the evaluation procedure is rather intricate. To this end, we have actively collaborated and communicated with major FMIs such as LSE, LCH to assess them with the review of RMB bond collateral. And in the future, we believe that with a joint effort, RMB bond collateral will play a more important role in the global financial market and effectively meet the needs of various innovative collateral business with both exchange and OTC markets. Thank you.
Great, thank you, Li Yuan. Graham, do you have any further thoughts on that question?
Yeah, just a very brief point. I think we do reference in our section of the paper in relation to the point that I mentioned earlier about optimization, about collateralization of derivative positions no longer being a kind of post-trade afterthought and being more commercially driven and more strategic. We mentioned that one of the or sort of a helpful factor in allowing for optimization is expanding the collateral use of an RMB bond. So for example, we talk about securities financing transactions, we talk about stock lending or repo. So I think that's the only other point I would add, that if, as well as being able to use RMB bonds for collateral in the OTC derivative space, it's helpful for, kind of further market liberalization and further traction on use of CGBs for the kind of asset classes that they can collateralize being expanded out. And I think that's sort of touched upon in our section of the paper.
Great, thank you very much, Graham. I think this topic is very popular, and I have just seen 4 more questions coming in. So we have limited time, so I'm going to probably spend another 5 minutes on the Q&A before I have to pass on to Susan for the next panel discussion. So I think I will probably quickly just read out through some of those questions, and then we'll ask Luke, Li Yuan, and also Graham to give your comments on that. So the first one is, what else can be done to make the pledge process described by Luke more efficient and scalable? And the second question is, does Luke see any noticeable differences between Bond Connect or CIBM direct access from a collateral management perspective? And the third one is also a question for Luke. You're very popular. If a client holds RMB-denominated bonds via a custodian different from Standard Chartered, is it still possible to open this international custodian account with Standard Chartered? How does it work in that case? And the last one is, which group of users do you see the greatest demand from CGB collateralization in the market? So I think, Luke, I probably will pass on to you first to answer some of those questions.
Okay, thanks very much. And great commentary by Graham there as well around collateral being part of the sort of almost pricing factor of a derivative transaction. We certainly see that as well. Okay, improvements. I think transfer free of payment would be excellent. That makes it very straightforward. And it means we can move collateral out of a pledge account into our own accounts, our own trading system, without having to go through this more convoluted route. So transfer free of payment would be excellent. Bond Connect versus CCIBM, probably I'm not the expert to comment on this one, but obviously they are 2 different legal models, with the certificates for Bond Connect being onshore in Hong Kong. That's a more familiar legal framework, let's say, than onshore China, but we're seeing progress being made there with what's been discussed already. So I think that difference falls away somewhat. And I have seen with clients preferences for both. So it's not like one overrules the other. I think clients see different merits in both different models. I think eventually having direct access to the market and the assets at the clearinghouse rather than going through a certification program may well prove to be more popular with certain types of investors. If we use a different custodian to SCB, that's possible, absolutely. It will be easier for us where we have a few improvements made, like the transfer free of payment, but we have the same setup with a third-party custodian, not for Chinese govies, I hasten to add, but for other bonds, for other sovereign debt. But I see no reason why it can't be extended to include a third-party custodian, as long as they can support all the different steps that we need to go through. And then the final one was, can you just remind me the final question on that? The different users, I think it was, wasn't it? Who are the different users?
Which group of users do you see the greatest demand for this?
I mean, clearly it's financial institutions, and then within FIs, it's hedge funds to start off with, and then real money. And the reason being is that hedge funds are trying to run a more leveraged book, so that the eligibility criteria of collateral with their prime broker or with their ISDA counterparty becomes very, very important and really helps them to achieve the kind of investment returns that they're looking for, partly through that leverage.
Great, thank you so much, Luke. Liyuan and Graham, do you have any further comments on those questions?
Not from me, I don't think. I think my colleagues are far more the experts on these matters. Thank you.
No, I have not any other answers. Thank you.
Great. Thank you very much, Liyuan, Luke, and Graham, for your excellent contribution to the topic. And next, I would like to pass the floor on to Susan Yu from Standard Chartered Bank, and to moderate the panel discussion. So, Susan.
Thank you much, Faye, and also thank you for CCDC, City of London, and PBOC organizing this very insightful workshop, especially being honorable to able to moderate a panel discussion with 4 very prominent speakers in London. So if I may, maybe just a few minutes to give a brief introduction of our panel speakers. Ladies first, Ms. Jeannie Yan, Managing Director from ICBC Standard Bank in London, and she's the Chief Economist and leads the China Market Strategy and Research team. And thank you for joining us, Jeannie. And second speaker is Mr. William Wu, who's the Acting Head of Financial Institutions of China Construction Bank in London branch. Since 2014, he's been responsible for developing and expansion of RMB related business in UK, especially on the RMB clearing bank business. And our third speaker is Mr. Sean Murray, who's the CEO of Margin Reform, which is a consulting firm. And you hear that Margin Reform have been providing consulting services to the white paper issued by CCDC and ISDA. And Sean also spent over 30 years experience across front office, credit risk, collateral management functions as well in tier 1 organizations. And the fourth speaker is Mr. Paget Bryant, who's the partner of Clifford in London and specialized in areas about derivatives and financial market products and structured finance. Thank you for joining us for all these speakers. And I think in the last 1 hour time, we hear a lot of insights about how to unlock the potential of using RMB assets for collateral usage. We hear that what are the mechanisms available to establish the enforcement rules in China in domestic markets. And in the offshore market, we hear that how a prime services model can be taken CGB as a collateral for initial margin usage. But one thing I pick up from Scott's presentation is the importance of enforceability of closeout netting. And since we have a partner from a prominent law firm, Clifford, so Paget, would you mind helping to explain a little bit that what does that really mean? And if it's such an important step, where we are in terms of this journey? Thank you.
Thanks very much, Susan, and good morning, good afternoon to everyone. And thank you for having me today. It's been a very long journey. As some of you might be aware, I spent over a dozen years working out in Hong Kong and China. And I was around in Hong Kong during the sort of years after JITIC, which was an insolvency of a Chinese entity. And I watched the development of the sort of discussions really around the development of the derivatives market in China, but also the importance of having a Chinese netting legislation put in place. And it's worth really just covering a couple of the issues as to why that's so important, and also the steps that are currently going on that Scott mentioned around the new futures legislation. So basically, just stepping back a bit, China has a civil code jurisdiction market, and the legislation is often regarded as needed to basically bring in principles. And a common principle that people look in the derivatives market is, how do I make derivatives close out and net on the insolvency of my counterparty? Now that is basically looking at your contract and saying, I have some features within it that basically allow for termination and for this function of closeout netting, which is really the bringing together the values of certain contracts I have under that agreement. Now, China's not unlike any other country where those questions are asked and often require a fix the legislation regime to make that work. England is different. It has a sort of common law approach plus some legislative solutions, but lots of jurisdictions have a civil code system, and ISDA has produced what they call the Model Netting Act, which supports that, and it helps countries develop a regime that allows for the system to be seen as recognised and enforceable. Now, if you basically need to ask yourself a few questions when you have a Chinese counterparty, is what happens when they go insolvent? And now Chinese bankruptcy law is relatively new. I mean, England's been sort of looking at these issues for a couple of 100 years, whereas the sort of maybe the Chinese bankruptcy law has only been around about 14 years. Is the first question is, can I actually terminate on the insolvency of my counterparty? Does my right to terminate still work, or is it sort of trumped by bankruptcy law? Second thing is, can I close out all my transactions together? So let's say I have 100 transactions under a master agreement. Can I close them all out, and then can I bring them all together as one net sum? And can I reduce all of it to the single claim and then claim for it? Now, if you think about contract law, that usually works, and Chinese set-off is recognized under contract law, and therefore the idea of netting is recognized within Chinese law. But the idea of bankruptcy law might trump that function. And therefore you have the question is, would a liquidator of a Chinese entity stop me from doing any of those things? And again, that is not a unique problem. That's a problem that we have in all jurisdictions. And we get opinions from local councils, i.e. Chinese law firms in this case, to confirm whether it would work on the bankruptcy of a Chinese institution. And I think for this market, what we're really talking about is really the development of the banking business and the development of derivatives and derivatives within the banking business. Now, of course, as I mentioned, Chinese bankruptcy law is pretty new, and therefore we don't have the case histories, we don't have the precedents, but also we haven't necessarily got the textual legislation. But we have always had very strong support from the regulators and from the Chinese Supreme Court to say, look, these are good areas, and we would like this to develop. And the financial crisis did show that this was a good area of bringing down risk mitigation. Now, for China, the issues really under the Chinese bankruptcy law boil down to three sort of problems or questions that need to be resolved. The first one is under what we call Article 18 of the bankruptcy law, is does the administrator have the power to cherry pick my transactions? And by that I mean take individual trades and say, I like that one, but I don't like that one. So please perform on this one, but please sue me on that one. But do I have to take them all? The second thing is the netting sum once created, could that be challenged by set-off not being seen as enforceable? And that's what we say is a problem under Article 4 of the bankruptcy law. And then the third question for banks is what happens in the bank resolution regime? Could that be a stay on therefore being able to enforce my rights of closeout and termination? So to get to a clean netting opinion, as I said, the regulators and the Supreme Court have always been very supportive of it, but it's always been regarded as needing a piece of legislation fix. And really, before I just talk about that legislative fix, and just to sort of bring some of it together for the purposes of the margin conversation and the bond conversation, is that really the Chinese banks are increasingly using derivatives, and we saw that in the conversation today. And netting has therefore always been an issue. It's been an issue for the last 20 years, but because of the increases of capital charges for banks, it's coming expensive. And I think Scott mentioned that, both transactional costs, but also capital costs. But also you have to basically measure on a gross position, which means you have to take collateral on a gross position. And therefore this isn't a good deal for Chinese banks either, not all their Western counterparties. The second thing, and as that was the white paper emphasizes, is that the regulatory margin regime that's been phased in that Scott mentioned is going to bring in more Chinese institutions and require margining on that basis. And therefore it reduces interbank credit risk and therefore reduces the risk of another financial crisis, but also is good regulatory governance by regulators who are all signed up to the idea that this is a good plan. Now, collateral is often provided in two ways, outright transfer or security. Now, outright transfer works by providing you with collateral and treating it a bit like a transaction. And if you go insolvent, we close out and we net that position. So for that to work, that collateral function to work, we need good netting. So it's the similar risk as closeout netting for transactions as it is for title transfer collateral. And that concept of title transfer collateral is quite an English law idea, but not a Chinese law idea. And therefore, one of the questions for the new legislation is, could you bring into that collateral regimes for title transfer? And the second feature that we've been discussing quite a lot about is initial margin and also taking margin under security, which is where you take a pledge or a charge over an asset and can enforce it at certain times. And your question therefore is, can I enforce? But the other question is it netted down so that I can basically see this as a net function rather than a gross function and get collateral only on the net exposure, which of course, again, reduces the cost of everyone to the party to pay back the collateral they have to provide. Now, the draft legislation that came through, the draft futures law that came through at the end of April, and as Scott mentioned, I think some comments have been fed back to the drafters on that in China, basically helps fix a number of these questions, which I mentioned earlier. So what it does is it creates a statutory framework, which is great because that helps the opinions to be given. The second thing is that it basically says that the attempts to close out under a master agreement, but that's basically where that master agreement has been filed in accordance with the Article 34 of the draft futures law, will not be invalidated or revoked due to the insolvency of the Chinese counterparty. So that would suggest with derivatives transactions that basically if it's been filed, then you can close out and your piece of closeout mechanism will work. And that basically removes those issues I mentioned about Article 18 and Article 40. So once you can get to that net position, you should also hopefully be able to get the idea of you might have collateral to work as well. If you could, the title transfer collateral function can also be seen as really a contract that provides some function of performance assurance, which is also within the draft futures law. So you could find that what we call variation margin could work quite well. And then we're going to have to look at some of the margin issues for taking security, but that's really a secondary question after we've resolved the netting question. So as I mentioned, hopefully we'll get there quite soon. By that, I mean in the next year or so, rather than the last 20 years, to develop some form of netting opinion, which then gives comfort to the market. So with that, I think Sean will do, and back to you, Susan.
Thank you very much, Paget. I picked up a few points in terms of risk management, collateral management, credit risk as well. And I think that maybe Sean, can you come in a little bit to explain or supplement what Paget have been mentioned on this area in your space, especially on the collateral management side?
Yeah, certainly, Susan. Thank you. And thanks, Paget. It was really conclusive. So I guess my interest was piqued once I saw the announcement come out about China, and India actually was an announcement just previous to that. It was announced that there was an official announcement from ISDA going to be imminent. So it made me a bit inquisitive as to when that netting process started with India, and I was able to find reference to a letter that ISDA had written, dated the 12th of October 2012, the 2012 netting letter it was known as, which set out the netting view or netting position on the view for India. We're certainly not a decade behind where we need to be now in China, but you don't need to tell me that decade was quite long from an Indian perspective. So I think it is worth reiterating that while we're hearing from that lawyer at the moment, Paget, the road is long and it's littered with challenges for lawyers, for regulators, for industry bodies and for market participants. And all of those issues need to be considered. They need to be potentially resolved or amended before such an opinion, a legal opinion, will be given. That's really the starting point. So if you get the legal opinion, you then end up in this situation where there's the implementation that needs to happen across the market, and all of the market participants each having their own due diligence, their own risk committees they need to go through, their own capital committees they need to go through, and they will have to understand what it means for their portfolios, for their organisations, and they will go through that approval process before they turn netting on, whether it be for India or it be for China. So I think actually everything we're talking about is all knitted together, and we'll obviously expand on that as we go through this webinar. But I think that's critical to remember, is once the opinion's there, that doesn't mean it's all done. It means that each individual entity has now got to go through its own individual process, which is individual. It's not a market process to turn on netting, whether that be for India or for China.
Cool. Thank you very much, Sean. So we also hear that from Paget's presentations about Chinese banks facing some troubles, especially on the derivative side that we're trading. Since the Chinese bank actually probably is the biggest owner of the RMB assets in onshore, we'd also like to hear from Ginny and William that how do Chinese banks play a role in increasing the RMB assets as collateral? What are the challenges and hurdles? And what are the suggestions you probably make in the industry bodies? Maybe we'll start with Ginny first.
Thank you very much, Susan. And thank you very much for inviting me and having me on today. I think it's a great pleasure. And we've already heard from all these experts. And I think it's very important for participants of the markets from different sectors and different financial areas to get together and discuss the challenges. But maybe from my ICBC lens, what I can say is that one of the key things that's quite unique, I guess, about China's market, and particularly from RMB internationalization and asset class perspective, is very much from the beginning, it has been policy-led, in that it has been guided by many policy reforms, particularly onshore, driven by regulators, central banks, etc. But going forward in terms of RMB internationalization, the pace of change will be actually driven by market participants. We've seen that already with the interbank bond market in particular, in that the index inclusion involved a lot of dialogue between investors and regulators, participants across the board and cross-border as well, to really address the challenges. And that's why we saw such a rapid pace of change in that market. Now, I think similarly for the derivatives market, the futures market, and of course RMB as a collateral, similar thing, it has to be very much driven by demand. And those issues that have been clearly raised by all these questions we're seeing on the chat about facilitation of due diligence, simplification of the channels of access, so CIBM Direct versus Bond Connect, how do you manage your collateral on both access fronts? Those points need to be much clearer, I think, going forward if we are going to see a scaling up or critical mass of this market. And I think both as a Chinese bank operating in London in a foreign jurisdiction, whereby Chinese banks also are learning from foreign banks and how to operate in a wider global market, learning by doing, in that these are the challenges that one day, despite being a unique policy-driven market, China and the RMB assets will start to face. On your point about, I think, Chinese banks, Chinese market makers, in particular on the onshore market, I mean, of course, that's relevant in that, Chinese banks, particularly the state-owned banks, are definitely the largest holders and participants of the bond market, particularly CGBs and other policy bank type of bonds. Perhaps not so much the entire market, as we know there's many more bonds out there like credit market, etc., which is not really what the core investment products are, particularly for state-owned banks. But particularly for these CGBs, the risk exposure is very different to other types of bonds. So therefore, I think if we are purely talking about CGBs here, the risk exposure is very much a sovereign risk exposure. So obviously the challenges we heard from Pajay and other colleagues about, things like, insolvency, etc. Perhaps, that will come naturally down the line when we're talking about other types of assets, particularly credit bonds, etc., credit derivatives. But at the moment, I think the market development is very much for CGBs and perhaps further down the line, policy bank bonds becoming the collateral. So I think in terms of this dialogue, we need to continue to deepen and facilitate the demand-driven progress of this market. And then one just maybe last point, I think there has been already a lot of progress being made. I think we've heard from Standard Chartered Bank, also my previous employer, but there has been some tri-party platforms available via the Bond Connect that has used RMB as collateral. And similarly, we're seeing an innovation by custodians in particular. And I think that will continue. But the key, as I said, I think at the beginning, is really going to be dependent on where the appetite is. We heard from a previous speaker that the collateral will be mainly demanded by hedge funds. So these are the ones that cannot or would like to access this market differently from the real money, so the longer term investors who really do not leverage in order to access the Chinese onshore market. So I think that is the point I want to make today. I think mainly 3 Ds, just to summarize, which is the market will be increasingly demand driven. So any of the developments on this market will be very much to facilitate the challenges that investors themselves are facing, whether it's in terms of regulatory or in terms of funding. And then secondly is deepen. This market is deepening because we are getting, CGBs being more liquid across different time zones. And that's why London is so important, because outside the Asian time zone, sometimes that liquidity starts to disappear. So when we're talking about any of these derivatives market, we need to start thinking about RMB as if it was similar to any other G3 currencies, essentially, because we're seeing liquidity building across different time zones. And then third, but not least, but due diligence. I think that is a real hurdle, is how to assist investors, not only in the China jurisdiction, but as we heard from Pajit already, once you start to use RMB as your collateral, which jurisdiction, which legal jurisdiction are we facing? So these are, I think, the 3 Ds I wanted to summarize. Thanks, Susan.
Thank you very much, Ginny. This is a really great summary. Like we can always remember, so demand, depend, and due diligence. And thanks. And probably we'll pass on to William. I think he can share more insights about what kind of practical cases we are using in terms of using RMB as a collateral. William.
Thank you, Susan. Thank you for having me here today. I would say right now, in terms of RMB internationalization, if I remember correctly, it's now 12th year since 2009. Throughout these 12 years, Chinese banks are always playing a very active role, from trade settlement, cross-border RMB trade settlement, to the RMB investment products, to the inclusion of SDR, and now to the RMB assets as the collateral. So Chinese banks are always playing a very active role. I think during this process, Chinese banks can play 1, facilitator, 2 is a key player, 3 is can play a pioneer role. Why I say facilitator? Like China Construction Bank, ICBC, we have international presence. More importantly, we are rooted in mainland China. We understand very deeply, thoroughly about the Chinese rules and regulations. For that, we can offer, we can working with CCDC, with other partners to provide one-stop comprehensive service, including access to the Chinese onshore market via CIBM, via Bond Connect, including RMB clearing, which CCB London has the unique advantage. We've just exceeded 50 trillion yuan accumulated clearing volume. That's a infrastructure service to the market for cross-border RMB business. Also including hedging. Just now I heard a lot about a lot of needs for hedging. Chinese bank based in China can offer not only interest rate hedging, but also FX hedging. More importantly, we can offer those bond trading agent. CCB is the ranking number one among CCDC for trading agent. And also we can provide, like SCB, just now Luke mentioned, the custodian service, working with our partners. Of course, we are also taking a pioneer role to do some innovation. Just now I heard a lot of discussions with regards to the legal framework, like close-out netting. We CCB also are working with CCDC to explore a, how to say, mutually acceptable or compatible legal arrangement, step by step. Maybe not from derivatives, as you know, derivatives are maybe quite still a complicated business involving like CCP, like more than 3 counterparties. We are now exploring a tri-party agreement, which have included those closing out netting framework, which we called cross-border settlement facilitation business, working with CCDC. CCDC will play the collateral manager role. We are seeking partners to be pledger, and we also, CCB can play a role as pledgee. By doing so, we can collateralize onshore CGB. Offshore, we can offer short-term financial liquidity support to overseas investors. This is very important because throughout RMB internationalization, liquidity supporting is the key. Overseas investors need to access the liquidity. By doing so, they can collateralize onshore eligible assets and got liquidity offshore. This is a pioneering process or product. We are now working with CCDC. It will be implemented very soon in the next few months. In terms of the hurdles, from my perspective, again, it's the understanding of regulatory requirement onshore. Second is the legal framework. Both Sean and Paget has discussed a lot. Thirdly, I think it's about the CNH and CNY issues. There are always 2 yield curves. There is always 2 currency codes representing RMB. This sometimes gives some confusions to those participants. For that, RMB Clearing Bank, like CCB, is actively offering solutions. And finally, I fully agree with Madam Jing Mei. RMB internationalization is a process which is market-driven, and it's a natural process. Thank you very much, students.
Thank you much, William. And since we touch base in terms of on the Chinese bank lens, maybe we zoom out a little bit to look at on the global perspective. And Sean, I really wanted to leverage your expertise in terms of collateral management. What do you see potentially is the roadmap of RMB assets into this global collateral landscape? That how can you help us to picture that? What is the roadmap over there?
Okay, thanks, Susan. I know we're running short of time, so I will be brief. There's one thing I did want to point out that I took out of the white paper myself, though, which was that in a survey in 2018, over 86 global FIs said 71% were willing to accept onshore CGB. So I think actually that tells you we're in a good stage of development with regards to usage. The 3 main stages, I think, for that, 2 are connected. The first 2 are connected. One is around accessibility and alignment of global markets. So we know today that CGBs are not commonly used as cross-border assets. They need to be able to fit in collateral terms, whether that is for repos or securities lending, or to satisfy an obligation under variation margin or initial margin, maybe an exchange trade or a CCP. You need to have that interconnectivity. So that connectivity is a big word, because connectivity to market infrastructure, which is the second point, is something that has been discussed today. So connectivity to custodians, to ICSDs, to the dealers. It doesn't stop there, though. You need connectivity to different market infrastructure. So is that trading venues? Is that to a fintech? Is that to a provider who is offering settlement services to the market? There's a whole host of different providers out there who are servicing collateral management and the needs of collateral management since the crisis of 2009. But the third stage, which I think is where I'm going to focus and is clearly as important, is about efficiency in operations. And Graham touched on it. So it's the forgotten part, or has been historically the forgotten part of financial markets, the post-trade environment. The post-trade environment can be anything that is all part of the regulatory journey. It might be trade reconciliations, it might be reporting, collateral settlements, it might be bond settlements, it could be dispute management. But all of it now ties back into requiring some level of oversight, some level of good analysis, some level of efficiency for the market to be able to function under a regulatory and in a regulatory environment. The utilisation of CGBs, though, will chuck up a few different challenges for organisations to overcome. And none of them are going to be new. It's just going to be additional challenges on top of the regulation. So I've got 5 of these, which I'm going to focus on. One is around market data. And so what does that mean? Well, it means static data. It means credit ratings. It means consuming data from data providers into your technology, into your front office systems, your trading systems, your collateral systems, your credit systems, so that you can move and understand what CGBs do, how they operate in the market, what static data comes with them. Clean static data, as we all know, is the problem that every organisation has, is making sure it's clean and it's consistent. Data affects pricing. So pricing of derivatives, Luke mentioned earlier, institutions need to know what collateral they're going to post or could post when they're executing a derivative. If clients want to post to you a CGB, or you want to post to a client a CGB, you need to understand that there will be an impact on your pricing, on your risk and your margining. Some would call it XVA. XVA desk would be looking at this in detail, and that will affect how you trade that derivative and how you price that derivative with your client. The third point is around segregation and settlement. For UMR, we know assets have to be segregated. So can you prove that they're legally segregated at an onshore custodian, if an onshore custodian needs to be used? That is something that we'll need to get through. Are you able to then settle that collateral on a timely basis based on the regulators under which you are trading or under which you're operating? It might be T0, it might be T+1, it might be T+2. You will need to understand that process. You'd want to know you've settled. It's about actual settlement, not assumed settlement. The fourth and fifth are somewhat interlinked and are around sort of the new regime of collateral management, so inventory management. When you have a CGB or any asset for that matter, you need to know where it is. You want to know where it is. You want to know whether you can mobilize it. Is it locked up? Is it in an account that's segregated? Is it just in an omnibus account? Can I move it from custodian A to custodian B seamlessly? Do I need to touch point? Are there touch points? Does it need to go through my ledger in and out, or can it just move? And there's an automated transaction that takes care of that from a finance perspective. That's really critical as we start thinking about the seamless movement of collateral. Tied into that is optimization. Everybody's collateral costs are getting more expensive. They're going up. They're not going down. They're all going up. And so what we've seen is a dramatic sort of change in the cost base for collateral management across the globe for certainly the biggest dealers, and it's now shifting through the UMR scope of clients that are getting impacted to phase 5 and phase 6. Therefore, being able to diversify and change the collateral you use becomes critical, because it enables you to post cheaper collateral or to use collateral that is not as expensive in the way you satisfy your collateral obligations. That's the 5 things I would focus on. How do we get there as a market? Well, if I think about CCP, I mentioned this earlier, everyone's got their own risk committees, capital committees, processes and policies and procedures they need to go through. They will have their own governance, they will have their own understanding of what they accept and what they don't accept. And Luke alluded to the fact they have some restrictions for concentration risk and wrong-way risk already on the services they offer. So if you think about market participants, if I think about CCP, for instance, the CCP risk committee will be made up of the dealers, the largest banks. It will be made up of some large buy sides. And these are the people that will probably be sitting on the committees internally at those organizations. So it's almost like the same people in the individual organizations will be sat on potentially the CCP, determining whether or not a piece of collateral is eligible or should be made eligible or not. Now, what's going to create that environment? Well, a commercial environment is always needed, because there's no reason to do it. So is that a client request? Is an opportunity for dealers to provide services to clients such as the one Luke presented? Yes, these are all commercial, and these are all reasons why we could end up in a situation where CGBs become a fully fledged and acceptable part of our industry and collateral within the industry.
Thank you. Thank you very much, Sean. Thank you for all the insight from our panel speakers. I'm just conscious about the time. We see some questions coming through, but probably we'll take them offline, and we will try to provide those answers to the questions to the audience later on. Thank you very much for the panel speakers. Faye, I would like to pass it back to you.
Yes, thank you very much, Susan, and thank you for all the panelists for your excellent contribution today. And thank you to all the speakers and for your contribution. And we have learned extensively about the subject, and I think more to discuss. And we have come to the end of today's session. And for audience, if you have further questions and you would like us to ask the speakers, and please do reach out to us via email. And thank you again for joining us today. And we look forward to seeing you at our next workshop. Thank you, everyone.